a barrel on Brent, still well below 90 on WTI, trading 87, 88. So clearly markets are still in a sense of swiveling between demand destruction concerns and supply tightness concerns, and the battle goes on. Will we actually get a direction? That is the question. And let's kick that off with Kate Durian, Meet contributing editor and non-resident fellow at the Arab Gulf States Institute in Washington. Does this market yet have a firm direction between those two stresses, Kate?
I don't think so, and I don't think that OPEC Plus helped by this sort of seesawing of 100,000 barrels a day increase and then 100,000 barrels a day increase a month later, which is really a drop in the ocean. If you look at the numbers, supply is pretty tight. It's not, even if OPEC increased their production by close to 1 million barrels a day in August, they're still about short overall. The whole of OPEC Plus is short by about 3 million. So you've got the start of the hurricane season. You don't know what Putin's going to do next. Is he going to? There's a meeting in Shanghai, which is going to be quite interesting to see how that goes. Iran may not be coming back. So I think the market is tight enough that any disruption is actually going to push prices up again. On the demand side, you've got China, which is a big unknown because we don't know when the next COVID lockdown is going to be. But if they come back, they'll come back with a vengeance. So I think it's this sort of, the market has lost its direction because it's not a normal market. You've got high volatility because liquidity is low. And that leads to these mad gyrations. So you've got it falling below 90, going up above 94. Everybody has actually reduced their forecast for the year, but I don't think anybody really can see clearly at the moment.
Let's welcome Jose Chelhoub, political risk and oil analyst and former analyst with PDVSA in Venezuela. Jose, let's just start by looking at Venezuela and then maybe talk a little bit more about the whole of the South American energy sector. But just Venezuela in August, I don't know if there's anything to read too deeply into it, but we've had more shipments of fuel oil, methanol, and petroleum coke coming out of Venezuela in August to boost oil exports to the second highest level this year. Is there some kind of a change of dynamics in Venezuela?
Well, thank you, Sean. Yeah, well, we saw, even if we saw recent numbers of production of Venezuela for the last numbers plunging again below the 700,000 barrels per day, it's interesting to see the latest data of exports rising again over 700,000 barrels, but of byproducts, especially petcoke, petroleum coke. And this is quite interesting because I remember when I was working still there in PDVSA, seeing these huge mountains of petroleum coke in the Jose complex. But I mean, due to different technical problems, lack of maintenance of facilities, but those problems have been trying to be solved in recent years, and especially after a recent construction of a private port by a businessman linked with the government, and trying to get all that coke, petroleum coke, out of those facilities, and especially demanded by India. India is demanding huge tons of petroleum coke from Venezuela. That's the significant thing about those exports of those recent data. And you have the other thing that Chevron has been waiting for the approval by the U.S. government, because Chevron has been in recent negotiations with PDVSA authorities, just waiting for the removal of sanctions and a new license to get new production out of Venezuela, which is still, I mean, that doesn't have.
Let's welcome Robin Mills, CEO of Camar Energy. Robin, I was just asking Kate the question of, this is a market that seems to be caught still between and somewhat in the headlights of whether it's demand destruction coming down the road at us or whether it's supply tightness, and it's frozen in that headlights. Your thoughts on where the dynamic is between those two and the efforts recently by OPEC Plus to move it towards supply tightness?
Well, I think at the moment, Sean, demand destruction is winning, and that's really a China story. Don't think we're seeing too much signs of demand destruction elsewhere. Oil prices are not particularly high, not crazily high anyway. Obviously, there's concerns over the general economy and interest rate rises and so on. But it's really a China story. That's where the bulk of the variance in demand comes from, and that's so that's related to the economy. But I think more to the lockdowns, because those can wipe out hundreds of thousands of barrels a day of demand, at almost a moment's notice. That's really what we have to watch for. The supply tightness story, I think, and we've been discussing this for months now, of course, this is a story, coming later into the year. So far, though, that the market hasn't been too worried by that, and that's why we're in the 90s and not the 120s.
On that point of the later in the year piece, Kate, we've had Janet Yellen over the last few days actually saying in public that she identifies that we could see another spike in gasoline prices through the winter as demand surges, and perhaps we've seen some fuel switching given the cheapness, quote unquote, of oil and liquids versus natural gas. Did we lose Kate?
When you think about, it's
Sorry.
too early in the morning.
I know,
and
it's not even 4 hours difference yet.
I'm in Dubai next week, though.
Oh, alhamdulillah. Oh, good. Oh, great.
From next Wednesday. Anyway, so when you hear talk of the United States maybe thinking of banning the export of products, it doesn't really help. I don't think gasoline is going to be too much of a problem. I mean, in my opinion, it's sort of not the driving season anymore. That's past. It just, it's refining capacity. Again, it's the whole issue of refining capacity. If you look at what's happening with diesel, with gasoline, it's, we're still talking Russia, aren't we, when it comes to diesel? So I think it's a lot of it is sentiment. I think the market is driven a lot by sentiment. There is no real tightness. I mean, you're not seeing queues, like we did. Some people are comparing the situation to 1973, but I don't think it's that much of an issue. I think it's just the tightness of refining capacity, the fact that your whole spare production capacity is razor thin at the moment. So I think all of that is feeding into the price at the moment.
Jose, looking at the wider South American story, given the really the lack of development of new capacity in the region, putting aside baby Guyana, but ultimately with oil prices having been on average for the year probably close to $100 or more a barrel now, and yet we're not seeing really much capacity build in South America, and also not in North America. Your thoughts on the reasons for that generally?
Well, we have the entire region plagued by different political turmoil. I mean, for example, if you take a look at Colombia, ever since Gustavo Petro arrived to power in Colombia, he's pushing against the oil sector. I mean, in all of his proposals. You can only take Brazil out of that list. Brazil is the only player that, and you have elections in Brazil in October, where Lula is supposed to win again. So, I mean, but Brazil and Guyana are the only two players in the region that are, that are poised to take new production and have stable, oil production, stable oil industries. But the rest of the region, if you look at Peru also has been having lots of political problems ever since Pedro Castillo, the leftist candidate, arrived to power. You have Argentina. Argentina is plagued by different political problems and social problems caused by by the different economic problems as well. So you take a look at Bolivia. Bolivia as well is not really well after all the crisis that erupted after the toppling of the former president Yanin Áñez. So I mean, the entire region has been plagued by political unrest, by social unrest ever since the pandemic, or even before in 2019. So and as a consequence of the pandemic as well, the lack of investments in all those countries, oil and gas infrastructure caused all these problems. And you have an entire landscape today where all these leftist governments are, I mean, they don't have the money, they don't have the proper resources, just like unlike in the 2000s where you had the Chavez, the Evo Morales, where they have lots of resources, but all that money were wasted. I mean, they didn't invest properly in new production. So the entire region, I mean, I don't see how, at least for the rest of the year and in even to 2023, new capacity, and it'll all depend on the political situation here in the region. That's how I see it.
Robin, we have, obviously you mentioned China there and the challenges that they've had this year and continue to have with their zero COVID policy and declining energy consumption. But on the wider political stage in which the outlook for Ukraine and China's position there, we have a big meeting this week between the presidents of China and Russia, the first since the war, and notably we've had a visit to Russia over the last few days of the very, very senior member of the Politburo, Mr. Li Shansu, who is very close to Xi Jinping and clearly put out the stall there for the Chinese position, which you would have to say is a little bit further advancing. If anybody was sort of expecting any retreat or neutrality from Xi Jinping at the meeting this week with Putin, he seemed to double down and this articulating that with Russia, they were going to build a whole new, more just world. Your thoughts on the significance of that and what that means for Russia's position and the geopolitical premium that will stay or not stay in this oil market?
Well, I think China's still hedging its best to an extent. Okay, as you say, you had the visit, the Politburo members' visit to Russia, but on the other hand, it's significant. I think Xi Jinping, this is his first foreign visit for quite a while, but he didn't go to Moscow. He's deliberately had it in the SCO forum, where it can be presented as more of a neutral ground, and this is not just a thing about Russia, but about the other countries in the SCO as well. And I think China throughout this crisis has given a certain amount of rhetorical support to Russia. And look, I don't think Xi Jinping wants Russia to lose, and I think the fact that Russia is doing so badly is quite disturbing to him. But on the other hand, China has not given too much practical support in terms of, say, weapons or money. Yeah, of course they'll buy discounted Russian oil where that's available. But I think the Chinese have actually been pretty cautious, as they have been on Iran, about trying to go up directly against US and European sanctions on Russia. I think the longer term, the question is, what does this mean for Russia and China's relationship? And Russia is very clearly the junior partner. It always was, but I mean even more so now, because of its poor military performance and because of the tightening sanctions that it's under. And its inability to get out of those, and China has ways of exploiting that, I think. And obviously, if the Russians can't sell to Europe, they'll have to reorient their oil towards Asia, and that'll be China to an extent. It'll also be India. That's a big logistical issue for them. And then even more on the gas side, 90% of Russian gas exports go to Europe, 10% go to China. Russia's always, for at least for many years now, talked about reorienting that to China. That's always been, kind of phrase, a bit of a pipe dream, and I think the Chinese also will see that yes, they can take more Russian gas, but they don't want to get in the situation Europe's in and be over dependent on Russia, which is clearly an unreliable supplier. they'll take some more gas, but China is definitely not a replacement for the European market. So I think Russia will find itself in an increasingly uncomfortable position as very much not even a junior partner, even more, but more of a kind of a subject neighbor.
Kate, what is the optics of that look like from Europe? China increasingly sort of coming off the fence and even more emboldened in their support of Russia in this war in Europe. And we saw commentary over the last few days by the German economy minister indicating that the Germans were going to start restricting investment in China and German companies engaging. We've had the same from the US regarding particularly around semiconductor chips and so forth. But the optics of this conflict drags on with Ukraine and Russia and China's increasingly overt support of Russia in that. Are there consequences for China and Europe's relationship?
Well, I mean, yeah, if you wanted China to sort of move closer to Russia, you provoke them on Taiwan, which is what was happening recently, and that's a very sensitive subject for them. It raises sort of geopolitical tensions in the region just when you don't really need them. And also the other interesting thing is at the Shanghai meeting, you might have Iran being drawn into that whole group. And, Russia obviously wants to keep Iran on side. I don't think they're particularly keen on Iran coming back with a vengeance. If there's a nuclear agreement, which is looking unlikely at the moment, and selling oil to Europe. It's not going to go to the States. A lot of it's going to go to Asia. So I think you're seeing a sort of dislocation. You're seeing in geopolitics, you're seeing countries becoming more sort of inward looking. And Putin's, by cutting off gas supply to Europe, is trying to sort of divide and rule in a way, get the countries to say, hang on a second, why are we doing this? We're shooting ourselves in the foot and other people are going to benefit. And Russia's not really hurting. Yes, you see reports about the Russian economy is actually hurting. We don't know it yet, but, then you read reports that life in Moscow is normal, there's no shortages. The only risk, I suppose, is if the sanctions on oil imports in the EU come into effect in December and he has to shut down production, it may be very difficult for Russia to come back again because it's happened before.
It is increasingly looking like the European sanctions as a whole are fairly impotent. I mean, particularly around the energy, what they've been able to agree on so far has been fairly ineffectual. Any reason to believe that oil will be more effectual?
I think yes.
Impactful?
I think when the sanctions come into effect, I mean, already we're seeing a reduction in the exports to Europe. Because the EU, the UK has sanctions already. A lot of countries are not buying. The refiners are not buying. But the trade is shifting as well. You see, if you import oil and export products, India can do that, for example, because they're buying a lot of Russian oil from 0 to nearly 1 million. So if they refine it and sell it as products and make a profit, then the sanctions are ineffective. There are ways, and Iran showed that there are ways around sanctions. So I don't think they're really working at the moment, but I think there will be an impact from the embargo when it comes into effect. But, because you can only sell so much to India and China and, maybe Korea, but it's not, gas is more difficult, obviously, because you can't divert it very, very easily. And there isn't enough pipeline capacity to divert from Europe to, so that's going to hurt. But I think Robin wrote recently that, the revenues come from oil sales, not so much from gas for Russia. So I think that will hurt more.
Jose, just looking quickly at that points you were making regarding the Brazilian election, which of course coming up October 2nd, the biggest country in South America, the biggest energy producer, and a very significant actor. How stable is that as a democratic election, and will Bolsonaro and his side accept the result, or is there any jeopardy in that from a stable outlook for Brazil?
Well, I mean, there's been different reports and accusations of political violence already ahead of the elections. Just like, in Brazil, just like in Venezuela, every time there's a presidential election, both in Brazil and in Venezuela, you can see different types of incidents, political violence, murder of political activists on
I mean,
both sides.
you would clearly say that Brazil still has a democracy in a way that you wouldn't say Venezuela does. I mean, it's not an apples for apples comparison now, is it? Or
No, not at all. Not
Right.
at all.
Okay.
I mean, sadly, it's you're talking about two different countries. I mean, and of course,
my concern or question is, could Brazil drift towards a dysfunctional democracy if Bolsonaro was to lose?
No, I don't think so, because Lula proved when he was president. I mean, he did a good job. I mean, Brazil didn't fall like Venezuela fell.
And he went to jail.
Of course. And so, yeah, but I mean, he did a good job, and overall, and Brazil still is a good economy. I mean, has a strong economy, unlike Venezuela. I mean, Venezuela, I live here. So, I mean, there's a huge difference. And I don't think that Brazil, with a potential presidency of Lula da Silva, will fall under, a leftist autocracy or whatever. I mean, I don't think
a reaction like we saw in the US when Trump lost. Will the right get activated? Let's go to the survey question and give everybody a chance to comment on the opening question this morning. What will win out for direction of oil markets in Q4? Concerns for recession demand destruction, or two, supply tightness? Kate's earlier comments were that we were still caught in some limbo between the two. Robin was quite definitive that we're definitely in a demand destruction frame at the moment. Where do you think this sits through the fourth quarter? Will we find a definitive direction of either one of these? And with it, of course, the oil price moves accordingly. Robin, on the inflation piece, we have the ECB with a 75 basis point interest rate hike last week. We have the inflation report out in the US this week ahead of their next interest rate move next week or later in the month. Where does that play into this wider demand destruction or not equation, do you think?
Well, I think, look, both central banks are getting kind of hawkish on inflation, but I think the pressures actually in the US seem to be easing. Maybe we're reaching at the peak of inflation, at least core inflation. Gasoline prices, which are a key driver, are well down. But I think the Fed is still somewhat hawkish, and the recent comments kind of suggest that that's the line that they're taking, trying to avoid the mistakes of the 70s as they see it. Although today's situation is quite different. For the EU, I think a different situation where the drivers of inflation are more widespread, and obviously you've got this underlying issue of energy prices, so not petrol particularly, but electricity and gas, which is much more intractable than the US issue. So that's I think the two kind of countries or blocks are in somewhat different positions, but still both going to be pretty hawkish on fighting inflation.
Well, on that point, just to follow up, if you get, given the Fed and the US economy is the sort of juggernaut in the room, if your analysis is sus, do you think this will be potentially the last of the 75 basis points, that kind of scale of interest rate hike, and we might start to see a leveling or a retreat?
Well, that's what it implies if we're past the peak in core inflation. Yeah,
but it's still 8%.
Yeah. Well, that's a question. But you're asking about the peak of the. Are these the highest rate? We probably will see more rate rises, but will they be as dramatic as the 0.75? I think that's the question. And you'd assume that the pace of rises would slow down.
Kate, the similar kind of position for the UK. Obviously, the central bank there has postponed its announcement given the passing of the Queen, but it was expected to make one shortly. The outlook for the UK seems to be increasingly more brutal.
Yeah, I know.
Hence your departure.
That's why I'm leaving. Yeah, no. I mean,
the last train out.
I know inflation is sky high. I think it's you know, it's really going to be difficult for people. Let's see what happens with the new government and the plan. I mean, who's going to pay for Liz Truss's plan to limit the you know, the cost of energy on households? I don't know who's going to fund it. It's, you know, we're talking 100 billion plus. So I think governments are struggling to find a way out of this situation. But I mean, if you look at the inflation
Across Europe, not just the UK, it was my point earlier.
Yeah, but energy inflation is coming down a little bit. Again, you don't know what direction prices are going to take. We're entering the winter season. Europe seems to be pretty okay when it comes to gas storage. You know, they've been filling up. But I think the problem is that you know, everything that you fill up is going to have to be used. If you get a bitter winter, if you get a cold winter, it's going to be really tough. And you remember the IEA had raised its forecast for demand for oil because of switching gas, you know, gas to oil switching. So if prices come down as they have done for gas, I think you may find that they will have to revise again when this week they issue their new oil market report. So we'll see. I mean, you know, it's revision after revision. That's why I'm saying, you know, it's a market that really doesn't have a clear direction. So we just have to, it's all very new, you know, you're sort of going back to square one because we've never been in a situation like this before.
Let's get the survey result and give Jose the last word this morning. So kind of a tight answer here as well, between Kate and Robin's view. We'll put that out to social media and see where the rest of the people think on that. But Jose, looking at the perspective, clearly Venezuela knows a thing or two about record inflation. How is this overall equation with a tightening Fed and a more expensive dollar rate impacting or likely to impact South America?
Yeah, it has been. It has been, especially, I mean, ever since 2019, where the social unrest started here. I mean, you have a region depending entirely on commodities exports, just like South America. So if you have an entire different landscape here in 2022, caused by the pandemic and all the inflationary process going on across Europe and the United States and Asia and across the globe entirely. So South America is not going to escape this situation, as I told you, because it's highly dependent on commodities exports and of gas, oil, and other commodities. And Venezuela is not escaping this situation. We're still going under inflation, and even worse. I mean, we're seeing food prices again escalating after the government tried to keep prices under control, but with no luck. So I mean, this is a global problem, and Venezuela and South America is not. Are not escaping from this situation.
And probably don't have too many tools in which to escape from the full burden and weight of that. There's no $100 billion that Liz Truss can give out to the citizens of Venezuela or the equivalent thereof in South America. They got to take it on the chin, unlike the subsidy that we've seen, the bionic subsidy we've seen in Europe and America through COVID, and now it would seem in the energy crisis, the legacy of which one would have to think the chickens will come home to roost on that, what they will be. But right now, oil prices on Brent trading up at near 94.50. They're moving up higher in early trade out of Asia this morning. And recovering from that drop below 90 last week. Will they continue through the week? We'll have to wait and see. We're currently in a supply tightness concern moment. Whether that reverses as we've seen in other weeks recently, we'll see. Kate Durian, thank you so much. We look forward to welcoming you back into Dubai, your second home in the world. Robin Mills, thank you so much for joining us today. Jose Chalhoub, always great to get insights from Venezuela and South America in our conversation. So we thank you for that. Have a great day, everybody. Here every morning, 10:30 UAE time.